Good afternoon. This is Bill Kennedy, Vice Chair of Programs for the Global Interdependence Center. And on behalf of everyone at the GIC, welcome back to the executive briefing. Since launching the executive briefing last March, the GIC has explored many facets of the COVID-19 pandemic, including healthcare policy, monetary policy, food and manufacturing supply chains, trade, market narratives, and geopolitics. Through the remainder of 2020, the GIC will continue to deliver a combination of fact-based insights regarding the pandemic, as well as thought leadership on key topics, including monetary policy, geopolitics, trade, climate change, and artificial intelligence. The goal of these free webinars is to provide a neutral, unbiased forum where these key topics can be explored and help decision makers like all of you prepare and plan. As a reminder, today's event is being recorded. The replay and slides will be available on the GIC website later today. Now, I'm delighted to introduce two world-renowned experts on U.S.-China relations. Michael Drury has served as the Chief Economist for McVean Trading and Investments since 1992. He assesses macroeconomic developments around the world to help craft hedging strategies using futures markets in the interest rates, currencies, and industrial metals, and he's also the author of McVean's weekly economic update. Michael previously worked as senior economist at both Shearson Lehman and A. Gary Shilling and Company. Normally, Michael travels extensively in the United States and China, as well as Japan and Latin America. He's a non-resident member of the American Chamber of Commerce in Beijing, president of the Economic Club of Memphis, and a member of the National Association for Business Economics, also known as NABE. We're proud to call him Chairman Emeritus of the Global Interdependence Center. Michael received his bachelor's degree in economics from the Georgia Institute of Technology and did his graduate work at the University of Wisconsin in Madison. Leland is a leading authority on China's economy and financial system. He co-founded China Beige book in 2010, where he and his team provide proprietary forecasting, investment strategies, and risk mitigation solutions to chief investment officers and corporate boards. He appears frequently in television, radio, and print media. And before co-founding China Beige book, Leland was with an investment bank as a capital markets attorney based in New York and Hong Kong. Leland is a member of the National Committee on U.S.-China Relations, the Economic Club of New York, the Council on Foreign Relations, and a non-resident senior fellow at the Brent Scowcroft Center on International Security at the Atlantic Council. Leland holds a law degree from the University of Virginia, master's degree in Chinese history from Oxford University, a bachelor's degree in European history from Washington and Lee, and a graduate Chinese language fellowship from Tongkai University in Taiwan. Michael and Leland, welcome to the executive briefing. So to start off, I'd like to ask both of you in your prepared remarks to address the shifting interdependencies between the US and China. For decades, the US and China have benefited from positive interdependencies. Supply chains were integrated. We would buy Chinese exports, China would buy our treasury bonds. Life was good. In the last few years, however, the contours of what appears to be maybe a new war seem to have formed. US policy today is restricting the flow of certain technology to China. Global supply chains are being restructured, and something that's been accelerated by the pandemic, and emerging technology innovations are being balkanized between the US system and the Chinese system. So it seems what were once positive interdependencies have turned into negative interdependencies. So Michael, we're going to start with you. Do you agree with this assessment, and what are the implications perspective for macro uncertainties and the economic growth for China?
Thank you, Bill. I have a PowerPoint I'm going to work from. I'm going to talk to set up basically some of the background for the issues here. And then we'll, as Leland and I have always said, the questions are the fun part. So let's just go to the first slide. And the key for me is I look at the world differently than 99% of economists. I don't believe there is a US economy or a China economy. I believe there's a global economy and that it interacts. It's interacting less effectively now under COVID and some of the trade trends. But basically, I look at the world not as politicians look at it, but as CEOs look at it. And the way they look at the world is to try to figure out where they're going to manufacture, where they're going to hire, where they're going to market and sell, where they're going to invest capital, frankly, where they're going to pollute, which regulations they're going to follow, where they're going to pay taxes. And as they look at the world, the US is the top of the pyramid. It's the management, medical, finance, administration, the high-end services. Europe is primarily a capital-intensive manufacturing base, and China is a labor-intensive manufacturing base trying to move up into capital-intensive. And both of them have the same high-end services that the US has, but at a regional level rather than an international level. The next chart, please. So the first thing that we need to agree on is that nobody knows none. I mean, my current forecast for third quarter GDP in the United States is 33%. The Atlanta Fed's at 31%. The New York Fed's at 15%. That's kind of the range. So I'm very bullish the global economy, just to give you where I am. But there is a wide differential of where people think we're going to be. And we're 2/3 of the way through the third quarter. You've got a lot of information and nobody can agree on anything. And that's primarily because of COVID. The next chart, please. So if we start with nobody knows nothing, let's at least go to where the IMF thought we were or projected that we were back in March and April. And this was done when things were at their worst, so it's probably overstates how bad things could be, but I'm really focused more on the pattern and the relative movements. And the key to me is, again, if you're a CEO looking at the world, Asia is expected to outperform. The world economy, the IMF had it going down about 5% and then recovering about 5%. And so on average, over the 2 years of 2020 and 21, the world was going to be flat. But within that world, China was not expected to take a recession in 2000, grow 1%, and then rebound to 8% in 2021. That would give it average growth of 4.5% over the 2 years. Now keep in mind, China was growing at 6% going into the recession, and it was slowing. So most people would have expected numbers in the high fives in those 2 quarters anyway. So to hit 4.5% out of an expected high fives is pretty good compared to the rest of the world, where Japan, the US, and Europe, the other big economies in the world, they're all expected to shrink about 2% over the course of 2 years. A deep drop and then moderate recoveries. And they were all growing somewhere, the United States was growing 2.5. Europe and Japan were both growing around 1 before you went in. So that's a pretty serious shortfall relative to what's expected in China. If you go down the fourth line from the bottom there, China versus the US, the bottom line is that China is expected to outgrow the United States by about 6.5% over 2 years. So a 13% gap. That will take China from where it's roughly now, about 63%, say 2/3 of US GDP, up to about 72% or almost 3/4 of US GDP. Now, that's basically them growing a little and us not growing at all. But the bottom line is that will change the relative importance of China on the global scene. And that has been a problem, and we think is going to continue to be a problem for pretty much as far as the eye can see. Let's go to the next slide. So we break this down. We want to look at 4 key trends that I say are above the line and then 2 below the fold. And the 4 above the line that we focus on are the US virus, what's happening with the virus in the United States, second wave that came from reopening, and now whether there's going to be a third wave on going back to school, and a fourth wave sometime, late this year, early next year, when people actually begin to return to offices. I think each wave will be less dramatic than the one before it, but the fact that we're having waves and they're not in China and they're not in Europe is a significant factor in how the world's going to look over the next year or so. Second is the US money and how much we're spending to get out of this. Third is the Chinese money and how much they're spending to get out of this, and they're still ramping up while we're kind of in a holding pattern right now, waiting on the election. And then US-China tensions, which is the center of what this talk will be about when we get to the questions and answers, and whether that's rising or resting. And it's certainly rising from a United States perspective because of the political era that we're in. Whether it's resting, they just had the Beige meetings in China where the top current and former party members get together and discuss things. And they came out of that with kind of a let's just wait and see how the US elections go kind of viewpoint. Then below the fold, we've got Europe, which I just see as stuck in the middle. It's got a rising China below it and a US that's not going to give way above it. And they're just squeezed. And, I'm not really sure their policies matter a whole lot. And then the commodities producers who are basically price takers who are quite literally taking orders from China. And so the speed of China's recovery will determine the speed of their recoveries as well. The next slide, please. So on decoupling, the key point I want to make is that we've already decoupled. For a long time following the great financial crisis, the United States on the left scale here was somewhere between 20 and 25% of Chinese exports. And at the same period, we were on the left scale, between 6 and 7% of their imports. Since the trade war started in 2018, both those numbers have slumped significantly. We're currently running at about 17% of Chinese exports, and we're only selling them about 5% of their imports. So let's go to the next slide. And this happens in an environment where China is no longer a mercantilist. It's basically a role that they gave up back on the great financial crisis, primarily because China by that time was already the largest importer and exporter in the world. And if they expected to grow 8%, which is what they were still looking for back then, and the world wasn't going to grow at all, well, either they had to get all of the growth in imports and exports, or they had to find a new strategy. And they adopted a new strategy, which was basically a kind of go west young man, manifest destiny continental approach, where they developed domestically and have been developing primarily domestically for the last decade, where once exports were over 30% of their business, they're now under 18, and imports are about 15. So they're not insignificant, but it's not the driving force of their economy anymore. Next chart, please. Now, having said that, Chinese imports and exports, because they are the biggest importer and exporter in the world, can tell you where the global economy is. The explosion that they had in 2009 into 2010 is what brought the global economy out of recession. The kind of slowdown in their imports and exports that went on, partly as a result of Europe in the early teens, and then their own corruption crisis in the middle teens. Then they stimulated, and that helped the global economy pick up in 16 and 17. And again, since the trade war, well before COVID, imports and exports out of China were below the zero line, and then cratered in early 20. And now they're coming back, and they're just above the zero line compared to a year ago, which again is a low bar because they weren't really growing during the trade crisis. But it is an optimistic sign that we are going to get some growth in the world. Now, to put that in perspective, Chinese exports the last 3 months are roughly equal to where they were in 2014. And that's because you had this slump in 14, then a pop, then a slump again. And so basically exports haven't really grown while their domestic economy has grown significantly. The next chart, please. So, their trade deficit currently with the world, 400 billion a month, basically. That cratered early and it's popped now on PPE and exports. So the Chinese have recouped from a trade perspective the shortfall that they had, but everyone expects them to come back to a more normal range on their trade by the end of this year, early next year, primarily because PPE and isn't going to be needed once we get a vaccine or decent testing, and because you're not going to buy 10 Nintendos. I mean, the one or two that you buy at some point will be enough. The next slide, please. So in China today, I see two things that I find very interesting that are different on their policy, different during the Xi period. The Chinese have always used credit to get their economy out of a rut, and it usually was directed at real estate. That was definitely true in 2009 and definitely true in 2013. But when Xi took office in 2013, he was more concerned with reining in corruption and reining in his adversaries who might challenge him for control of the government, and in reining in real estate, which was getting out of hand and threatening the entire financial system. So basically from 2013 through 2020, credit's gone pretty much sideways in China. You've had your booms and busts, but you haven't had this perpetual rise that you had from 2005 through 2013. We're in a boom phase right now, and a boom phase that's pretty boomy. I mean, you've gone from 1.5 trillion to over 2 trillion pretty quickly. I mean, it's only been 6 months, and so they're really hitting the jets as far as credit is concerned, which is very unlike the previous Xi policies. They're still trying to keep it away from real estate, but that still means a lot of government-generated infrastructure projects. The next slide, please. The other thing that's different is currency. So from 2005 till 2014, the yuan basically got stronger. There was a lot of pressure from the US government for them to do this, and there was a lot of realization in China that if their currency kept strengthening, then they got to buy oil and cotton and copper and anything else they needed more cheaply. When Xi came in, again, starting with the corruption campaign in 2014, as he crunched the economy so that it was slowing, he allowed the currency to weaken to maintain some viability in the export community. Even though exports wasn't the driver anymore, they didn't abandon it, but that meant steadily weakening the yuan all the way back down to where it was during the great financial crisis. When Trump got elected in 2017, the Chinese thought they had a friend, and they thought they understood Trump, that he was a very transactional president, that he'd be interested in trade deals, and they started to let the currency strengthen again. And then you've got that oops point when the trade war started, and they let it drop right back down to that kind of great financial crisis right around 6.8 yuan to the dollar. And it went below that during the trade war and in the early part of 2020 on the COVID crisis. But now it's been recovering pretty nicely in the last few months. And we think that this is, again, a new policy where the Chinese are going to try to allow their currency to strengthen a bit to get an edge on commodities prices. The next slide, please. So China wasn't supposed to have a recession, and look at that, they didn't have a recession, or at least that's what they reported. They reported that industrial production never got worse than 4% on a year ago, and now it's running around 5% above a year ago, which, given that you thought their economy was going to grow 5.5, 6 anyway, it's pretty good. It's also not really horribly believable. The next slide, bullet, please. So things that the Chinese government can control, like car sales, because most car companies in China are affiliated in one way or another with provincial governments. Those things have done exceptionally well. So car sales, after a horrible first half of the year are recovering, making up on inventory. And then as in the United States, people don't want to get on subways or mass transit. So people are buying cars instead. So this is the strongest industry in the United States, in China, everywhere in the world in terms of rebound. And in China, it's rebounded already to above where it was a year ago. Next chart, please. But in the hardest hit areas like air travel, they've recovered. And, this is flight radar 24, so it's not Chinese data. This is somebody counting flights in China. They're back up to about 85%, and sources tell us that they'll probably be back at 100% by the end of September, the beginning of October. It doesn't mean the planes are full, but the domestic flights are flying. And the next chart, please. And another very hard hit area, restaurants. It looks like in August, they finally made it all the way back to where they were before, both in terms of how many restaurants were open and how many people were sitting in restaurants. My business is agricultural commodities, and my firm is very interested in the restaurant industry. So I actually was speaking with representatives of the U.S. Meat Export Federation yesterday, and they agree that these numbers are pretty accurate, that restaurants have gone back to normal, that China is acting at least as if it doesn't have COVID anymore. Next chart, please. But even in China, there are things that the party cannot control, and consumers are nervous. And so consumer spending, which had been on a long downslide anyway, cratered early in the year and is still below year-ago levels. Still, they say it's 4 to 5% below year-ago levels, but again, that's probably overstating. So it's the consumer, and particularly the middle class, that had been driving the domestic economy that's in the most trouble. That middle class is often very export industry oriented, and those have been hard hit by this. So that's the number that we're really watching to see whether China is coming back or not. And we're really watching whether China is coming back or not because we think that's the lead indicator for a global recovery. The next chart, please. So the number that we watch most closely, because we're in the commodities world, is China GDP in dollars, because that's their buying power for crude oil, cotton, copper, whatever they happen to want to buy. And you can see that, since the great financial crisis, that's been on a downtrend, except for that period where the yuan appreciated rapidly in 17 into 18. And right now it's below zero. Well, if you take the IMF's forecast of 8% real growth, and you take a 2% inflation rate on that, and then you let the yuan appreciate 5% against the dollar, which is on the low side of a lot of forecasts now, then China's going to go back to having 15% growth in its nominal GDP in dollars, which is all the way back to where you were 2011, 2012, much stronger than we've seen recently. And so that's the number we're watching closest to see if there is a upturn in the global economy. Next chart, please. And where you can see this is in commodities prices, where they're buying. So the closer the commodity is to China, the better it's doing. Iron ore, which comes out of Brazil and Australia and goes into their steel industry, is at near record highs. Next chart. Copper, which is a little bit more internationally transacted, but is heavily oriented towards both automobiles and housing and infrastructure projects, has had a nice little bounce. And then last of all, crude oil, which is a broad international commodity, still showing the wear and tear of the world economy, as opposed to iron ore and to a less extent copper, showing the bounce in China. So that's my story, and I'm sticking to it. We'll get Leland in here, and then happy to take some questions.
Great. Thank you for that, Michael. We certainly appreciate the insights. So we're going to make a transition now. Michael, don't go away. We'll get you back for Q&A. But Leland, the same question to you in terms of thinking of the what was once positive interdependencies to negative interdependencies. How do you think about that subject?
I think I'm going to approach this issue different than what Michael did. He's focused on the macroeconomics. I spend a lot of my time talking about macroeconomics, but I'm going to approach this from the policy angle. We have a run-up to an election I think people are very curious about. The title of the presentation I noticed this morning was Trump Trade Intentions. We may not have a President Trump in 6 months if he's voted out. So what I want to do is I want to focus on the policy side, and then I want to start from the near term, and I want to sort of move out, focusing basically on the way that the administration views policy, what it may do in the coming weeks and months, and how this is likely to end up in the coming years. Now, what I would love to start by doing is to present the administration's China strategy. The problem, of course, is the administration does not have a China strategy. What the administration has is a President Trump who's almost myopically focused on trade issues, and then a lot of other officials who have their various policy plans, their proposals, their desires to move the relationship in one direction or another. And depending on what the president's mood is in, depending on what's happening in terms of the trade back and forth, these officials, various officials, are empowered, sometimes on a day-by-day basis, sometimes weekly or longer. But China policy, for the most part, has moved for almost 4 years based on the ebbs and flows of whichever policy people are in favor at the beginning, which is why you can see certain things be described as extremely hawkish, others described as very dovish, and it all fits together because there is no grand scheme here. It's really sort of a push forward based on the president's whims. That said, I'm going to try to create a framework for how to sort of view the administration's policy going forward, and then what a president, be it President Trump, be it a President Biden, would sort of look at the relationship beyond 2020 and how they might approach this. The elephant in the room, bucket number one, of course, is trade. And it's very difficult to separate trade writ large from the idea of phase one. Now, the president came into office and has run straight through his 4 years with the idea that he was going to improve the trade relationship with China, which meant that the bilateral trade deficit would go down, the Chinese would import more goods. COVID got in the way to some point, but I think that when you look at phase one, you look at a deal that's in really terrible trouble. Phase one was designed so that it would be exports boosted over a baseline year, which is 2017, and you were supposed to have after 2 years from now, you used to wake up and there's been 200 billion in improvements in exports of goods and services. The Chinese are very far behind on this, and we can debate all day long how much of it's COVID and how much of it's not. The reality, though, is that not only are the Chinese commitments behind the 2017 considerably, they're behind even 2019. So basically, the deal is failing on all accounts. Right now, I'd say the Chinese are roughly 40 billion behind their commitments. They can catch up a little bit by the election, but the purchases component, which the president cares about deeply, is failing. And it will become increasingly difficult to defend this fall as both Trump and Biden jockey each other, trying to say who the toughest candidate is on China. So this is a real problem for the president in terms of optics. There are other components of phase one. There's an IP regime that the Chinese have put into place, which is mostly illusory. What's interesting is there's also a market access component, but the administration itself is walking away from this right now. If you've looked at what the president has been saying for the last couple of days in particular, it's all about decoupling. We're gonna separate the U.S. and China. We're not going to give funds to the Chinese Communist Party. Well, what's happening with phase one is the market access component is getting U.S. companies into China to take advantage of that market. And so the president and his team has been walking away from some of the market access benefits that they negotiated. So really, if you look at phase one overall, you see a deal that the president has not walked away from, but is becoming increasingly hard to defend. And I think that the chances of the phase one deal falling apart before the election are much higher than markets understand, simply because the deal, if it's not a benefit to the president and he's falling behind the polls, he's going to have to do a seismic change. This is one way to do it, would be to go at China, would to rip phase one up and to move forward. Now, the other important part of phase one is that because there is a phase one agreement, the president has been less aggressive on certain other aspects of the relationship than maybe Republicans in Congress or some of his hawkish cabinet members would like. Some of the other platforms that they're moving forward include the second bucket, which is Chinese tech companies. Now, this is something that wasn't being contemplated a year ago, but if you look the last couple of months, you've seen the headlines all about TikTok, about WeChat. There's even and of course Huawei for very different reasons. The issue is interesting because what the administration is trying to do is go after these big Chinese national champions, but it's not for one reason. The rationale for going after TikTok is different than the rationale for going after WeChat, and of course Huawei is a completely different deal altogether because of its role as a semiconductor champion and 5G champion for China. So the administration is targeting large Chinese companies, but for different reasons. And a lot of this looks like it's being pushed off past the election before any big things hit. But we've been told to expect more. The hawks are really and the administration are really into targeting the tech companies. And so this is the second bucket that I think that policy is being focused on right now. The third is supply chains. I think the major mistake that people make when they're talking about supply chains is seeing them as being monolithic. So supply chains will either remain in China or they'll be ripped out of China, and that's not really what's happening right now. You're seeing certain industries, particularly after the trade war and then COVID, and with the geopolitical tensions on top of the relationship, are being forced into making contingency plans that they otherwise maybe a few years ago wouldn't have contemplated. So you can't tell your shareholders anymore, well, we're in China and if bad things happen, too bad. There's been too many warning signs, and right now firms are having to figure out how they can pull some of these supply chains, how they can diversify them, create less China risk specifically. And this is very difficult, and it's much more difficult for certain industries than others. You also have a component of national security there. So when you're talking about something like pharmaceuticals, you're very likely to see either the administration have an executive order. There has been one sitting on the president's desk for 6 months that he hasn't wielded yet. You could see Congress involved, but a real concern over the Chinese government having leverage over the relationship by virtue of a stranglehold on either pharmaceuticals, medicines, or pharmaceutical ingredients. You could see legislative action push forward in the coming months that have to do with sort of ripping those supply chains out of China. But in general, this is a very difficult topic. And the second mistake made when talking about supply chains is you're not, just because you're ripping supply chains out of China or you're attempting to rip supply chains out of China, it doesn't mean you're reshoring them back to America. Most of the supply chains that are ripped out of China will ultimately go to Mexico, they'll go to Southeast Asia, they'll go to other countries. It doesn't make sense to bring manufacturing home across all industries. So there's a bit of an image conflation here, which confuses people. That said, supply chains are a major issue. I would expect there to be a lot of talk and some executive orders focused on fixing supply chains. This is what President Trump calls decoupling from China. And you're going to see a lot more of that in the coming months and certainly in the coming years. The last bucket I'm going to call geopolitics. And what I'm putting in this are a bunch of disparate topics that really don't have that much to do with each other, whether it's South China Sea, whether it's Taiwan, Hong Kong, Xinjiang, etc. Now, some of these are instances where you have the real potential for an either accidental or not so accidental slip, and there be a kinetic interaction between U.S. and Chinese forces. Certainly South China Sea, you're seeing enormous exercises by the PLA. You're seeing the American side and other countries much more active in the region, similar to what might happen in the Taiwan Strait. So you have the potential for there to be some sort of naval clash, probably much smaller scale. But what used to be, I think the key here is that what used to be rather outlandish and rather unlikely now has to be on your risk radar, because it could happen. The Chinese could feel pressured. The administration may have a different calculus on this and may want to press the envelope on China right now. You could see this type of problem develop in the coming weeks or months. Hong Kong, of course, is a very different beast. That's more or less a trade issue, but it's taken on sort of a larger role, particularly because the president talked about ripping away special status and treating Hong Kong just like the mainland, but has not done a lot of things that would put that into practice. So Hong Kong is an outstanding issue. A lot of this will depend on what happens to Hong Kong people going forward and whether dissidents are disappearing and whether it upsets people in Congress. But Hong Kong's an issue. But the last, and I think the most far-reaching issue that is not on people's radar right now enough is what's happening in Xinjiang with the Uyghurs. A few days ago, Disney released a movie, Mulan, which was filmed in Xinjiang, and the credits thanked the government there, the security forces there. This has become a political nightmare for Disney, and I think this is just the beginning. There is a major movement on both sides of the aisle, Republican and Democrat, China Hawks, human rights caucuses, to label what's happening in Xinjiang as being a genocide. Which has led to some sanctions on officials in Xinjiang. It's led to an announcement of trade sanctions on cotton, for instance, tomatoes, other things coming out of Xinjiang. This is only the tip of the iceberg. I think where this leads us to a year from now is a discussion on whether the United States and other countries are going to end up boycotting the 2022 Olympics in Beijing. I think that this is going to escalate dramatically, and that's where we're going, whether we end up whatever direction we go in. I think this is going to be a major political issue in 2021. So those are really four of the buckets right now. What I would say is the first, expect a very rowdy fall. Both candidates are going to be looking hard at being the most aggressive candidate on China, but also watch the polls. If the polls are strong, for President Trump, he starts rebounding, then there's going to be a lot of less of a pressure for him to jump in and do something dramatic. But if he's fading in the polls or he's being called out by Team Biden for being weak on China, then the potential for a seismic policy shift, whether it's ripping away phase one or something that's even more dramatic, it's there. It's there for the next 8 weeks in particular, and this should be on everybody's radar.
Great, thank you very much for those insights, Leland. So we're going to move to the Q&A portion. We're going to bring Michael back up on screen. And as a reminder, if you would like to ask a question on the go-to dashboard over to the right, find the tab that says questions. You can type in your question and that will put it into the queue. While we're waiting for a few of the live questions to come in, let me kick off. We did have a question asking, or stating, I should say, China has steadily reduced its holdings of US Treasury debt. The debt is 1.1 trillion as of June. What happens if this downward continues? So Michael, I'll give that one to you first, and then Leland, sure. See if you want to opine on that too.
So, this has always been an argument that, the Chinese are going to dump treasuries and it's going to hurt the United States. The Chinese have held roughly $1 trillion worth of US treasuries since 2008. The Japanese have roughly the same portfolio, and they haven't changed theirs since 2008. Now, the Chinese economy has more than doubled since 2008, and the trade deficit has been enormous. Yet they haven't used the trade deficit to purchase further treasuries in their sovereign fund. Now, they have other wealth funds that are purchasing, American assets. But the way I look at this is the Chinese hurt themselves more than anybody else if they dump treasuries, and they still don't have a tradable currency of their own, the yuan. So if you're going to be a large trading, enterprise, you have to have a large backstop in treasuries in order to be able to do that. Now, do they need $1 trillion? The Germans hold less than 100 billion. And, they're a big global trader as well. Now, most of their trade is in euros. So, but, I don't think either the Japanese or the Chinese are going to be dumping securities as the way to get back at the United States. What would they do? Dump them and drive our interest rates up 20 basis points? I mean, You know, we got more volatility and more issues with our own deficit than we do with the Chinese movement. I mean, their trillion is nothing now, right? I mean, Pelosi wants 3 trillion and the Republicans want 1.3, and I mean, so that we're going to do in 1 year what we think the Chinese are going to do to us over decades.
And Leland, any view on that?
Yeah, nothing's going to happen. Look, I agree with Michael that if they sell the treasuries, what are they going to buy? They need to be able to put the capital somewhere. It's not a safer investment than U.S. treasuries and agency debt. So, you know, they don't really have these options. And if they did sell, then someone else would buy them, and then the problem's more on the Chinese side. So there's a lot of things that keep me up at night. This is not one of them.
Great. So there's a whole list of questions with a premise of a Biden administration. So I'm going to try to bucket these if we could, and maybe we can tackle them. We'll go with Michael and then to Leland. But and Leland, maybe you first. What is the Biden China policy? How would you see it being formulated? And looking out 6 to 12 months after the election, how would it differ from what we're seeing today?
Well, what you haven't seen so far is a well-articulated Biden China policy, because I think that the plan for that team is to sort of sit back and let President Trump put his foot in his mouth and sort of hold back until they actually need to present things. What's very clear is that Vice President Biden has long had a relatively soft view on China. You know, by today's standards, you know, his views of 4 years ago or 14 years ago, they won't cut it in today's politics. So he's realized that. There's no mystery to anyone. And I think that they're doing right now is they're empowering the hawks in the Democratic caucus to be devising policy going forward. I don't think you're going to see a major break on a lot of these issues. You know, a President Biden would not have the same priorities as President Trump does. The trade will be an issue, but it won't be the issue. You're going to have to deal with climate change somehow. But overall, I don't think you're going to see any type of, you know, you could see a honeymoon period, but I don't think you're going to see any softening of tensions. I think what's happening right now is happening across the entire electorate, Democrat, Republican. Even if Vice President Biden, or when he's president, wanted to be softer on China, I don't think he could do that. So I think you're going to see a relatively consistent China policy. The big issue, of course, will be whether you can create a grander coalition with the Europeans and our allies in Asia in order to push back on China. That's certainly one of Biden's talking points right now. And then I think that the other issue will be, how do you prioritize the various issues? Are they going to care as much about Huawei? Or are they going to care as much about some of these tech companies? Are they going to care as much about pushing supply chains? They're trying to figure out their policy on Hong Kong and all these other things as we go along. But I think what I would not be expecting is a major break from what Trump's been doing. And I would not be expecting any pullback on tariffs right away. Now that the tariffs are there, even if Biden doesn't want them there, which is an open question, he's not taking them off unless he's getting something in return. So I think we're going to see a lot more consistency than we see divergence.
So Michael, in that same, again, under a Biden administration, 6 to 12 months out, do you see any shifts in agricultural trade policy or in technology trade policy?
So I think this comes down to bases, right? I mean, Trump's base is more in the agricultural sector and Biden's is more in the technology sector, the states that are big in these things. So I think you'll see some movement away from the agricultural policies and more towards, the issues on Huawei and Broadcom, selling and who's got rights to sell, et cetera. But two things, and I agree with Leland on this, is whoever's president is going to have a more adversarial relationship with China than people in the past. When Bush came in, they were 10% of our economy. When Obama came in, they were 33%. When Trump came in, they were 65%, and after COVID, they might be 75%. I mean, the child is growing up, and you have to deal with a bigger person over there, and they want more things their way. I think the biggest change under Biden is that we'll be less transactional, less trade-oriented, and more issues Xinjiang, Hong Kong, Taiwan, maybe not Taiwan, but oriented, and Biden's willingness to bring allies to bear, as opposed to Trump's not even willingness, but beyond that, inability to bring others to bear. I think that's what the Chinese fear more than anything else. They were willing to put up with Trump's erratic behavior if it was them against Trump. What they don't want is them against the United States and Europe. That's a battle they can't win.
So let me come to Europe in just a second, but there's a couple of questions here. Do either of you think that under a Biden administration, TPP, Trans-Pacific Partnership, is revived? Leland?
Not immediately. Look, if you have the last 2 years of a Biden administration or a second term of a Biden, you've established your priorities, you've shown your toughness. TPP is an issue that could be revisited simply because it goes along with the idea of creating a coalition, creating U.S. Rules that the Chinese have to adhere to. It can be resuscitated. But not immediately. I think that what's going to have to happen right up front is Biden is going to have to show his bona fides right up front, in that he is not going to bow down to the Chinese. He's going to have a much tougher policy. I think that a backtracking to TPP will muddle the message, even if it's a good idea. So I don't think TPP is going to be in play early on. We'll see where things are, 2-3 years down the road, but I don't foresee it being resuscitated in the early days.
Michael, anything to add?
Yeah, I agree. Trade, especially given that 4 years from now, Michigan, Pennsylvania, and Wisconsin are still going to be the swing states. I mean, the first thing you want to do out of the box is not say we need a more open trade relationship and bring the whole manufacturing argument back into things. Oh, you took our votes and then you stabbed us in the back. So I don't think, medical, education, security, I mean, there's tons of other domestic issues to address in the first year or two.
Okay. So Leland, this question's for you. It appears European views towards China are shifting towards the US perspective, or the US view. So Europe and the US may actually have one thing in common. Is the changing relationship between China and the US, is that being reflected in Europe or in other parts of the world based on your analysis?
Me or Michael?
That's for you, Leland, please.
Okay. Well, I think that the best case study for the evolving view of the Europeans on China is Huawei and the telecom sphere. Because if you look at what's happening there, a year or two ago, they talk about Huawei, the dangers, but it really looked like this was going in one direction. I think over the last year, in part because Chinese diplomacy during and after COVID has been deplorable. You're seeing more of a unified pushback against putting Chinese telecom into domestic systems. So I think that the Europeans and the United States will not see eye to eye on all China issues, but I think that there is a desire by the Europeans to fight in a coalition against a lot of these China issues if they're being treated in a certain way by the United States, which means maybe not have auto tariffs being threatened every 3 months. So I think that the opportunity's there. Look, if Biden did bring the coalition together, we will all see that there's enormous fissure points. It's not going to be a unified coalition. None of this is as easy as it sounds. But I think, yes, I think a lot of people are angry about at China right now, either for COVID or for not having a fair playing field for the last 20 years, or because of their enormous trade surpluses. And so people are smarting for a fight, and there is the opportunity to marshal support against China in that way.
Great, thank you. Michael Drury, for you, can we believe the positive economic data coming out of China?
This is a perennial question, is you believe the data. I don't believe anybody's data. I don't even believe data in the United States. I mean, try to figure out what the claims data is telling you on a week-to-week basis. It's a nightmare. I use all data on a relative basis. So the question is, do I think the Chinese are lying more about their data today than they were lying about their data 6 months ago or a year ago? And on that basis, for instance, the restaurant thing, that we have this running argument at my office. Open Table, which is a US-based firm, says that the United States is 30% behind. It says that Ireland and Germany and the UK are back to where they were pre-COVID. Well, why would they be back and we're not? Well, because we still got COVID and they don't. So the Chinese say they're all the way back and the Chinese say they don't have COVID. Well, that sounds like what the UK and Germany are telling me. So I'm more likely to believe those kind of preponderance of the evidence arguments than I am to believe some of their statistics on areas, like car sales or like where the consumer is, where I know that there's a bias to what they want to report. But we look at a lot of data from outside China. And that's Leland's bailiwick, is that he's got people inside China who are telling him what they might not be telling the government.
Understood. Thank you.
Yeah.
Go ahead, Leland.
Are you going to give me that question? No, I'll say one thing real quick about Chinese data, because I feel inclined to. Look, I won't simply say this stuff is fake. But what has happened over the past couple of years has been a good faith effort by the Chinese to have more and better sources of data. On the other hand, because of the difficulties, the Chinese system and Xi Jinping and COVID and trade wars and all kinds of other problems the Chinese have had, there has been more of a political sensitivity with releasing certain numbers or releasing them honestly. So on the one hand, you have a pathway towards having more realistic, better numbers. On the other hand, the Chinese Communist Party announced that they had vanquished the virus, back in April and May, and by damn, they were going to announce numbers that confirmed that the party did in fact vanquish the virus. So what you're seeing right now, and we have data that show this, the type of improvement China is recovering, the type of improvement the government is announcing right now, in most ways, is far exaggerated from what's actually happening, and so. The problems with Chinese data continue.
And I think
keep in mind, the Chinese have a huge party coming in 2021. It's the 100th anniversary of the Communist Party. They're not going to tell you anything bad about their economy from here through the Olympic Games. This is their ride. They've been planning for this for years. And so you're ramping it on. COVID was a big problem. Now you're ramping up into it. And I think you can expect better data out of China for the next year.
Great. And by the way, I think that's a key takeaway from this whole conversation, just what we just heard from Michael and Leland with regard to the quality of the data and the reason behind the data. I think equally important. So Leland, there's a question here about what's happening on the border between Chinese and India. And can you just talk about that activity and what you know?
Yeah, it's not just a tragedy, it's a gruesome tragedy. I mean, what seemed to have happened was a rather spontaneous uprising where people were pushing each other's off the cliffs and spearing each other. And what essentially happened is that the Indians were outnumbered after Chinese reinforcements came and slaughtered a bunch of Indians, although people died on both sides. And I think what happened after some thinking back in New Delhi was that, look, we're not going to go to war with China on the battlefield, but we're going to start making life real miserable for them. And what this is turning out to be, with that one regiment in the mountains for the PLA have done, is basically destroy Chinese market share inside India. India's banned apps, they've banned Chinese companies, and these are things that right now Beijing does not want to deal with, considering they're in a trade dispute with the United States, they're in a trade dispute with Australia, they're in all kinds of battles with Europe. Huawei's flailing, they've insulted Africa. So this was not what Beijing needed. But look, right now that this thing is sort of spiraled out of control. They didn't nip it in the bud, and now this is going to really hurt Beijing, both on the policy side and economically going forward.
So there's a question talking about U.S. financial institutions setting up shop in China. The FT has reported this. It's been widely reported, and it looks like they're trying to capture some market share out of the Chinese market. The question is this a mistake for those institutions? Michael, what do you think?
I don't think it's a mistake for the institutions. They start, well behind. They've been in joint ventures, and JP's taken over its joint venture. But I mean, there is a very serious, if you're well off in China, you pretty much owe your wealth to the party somewhere. I mean, somebody gave you a license, somebody gave you backing, somebody gave you access. And so there's a strong bias towards putting your money back to work in institutions that the government says are the ones that they want you to put your money in. So I mean, for US institutions to come in and just try to play on a playing field like they would in the United States is extraordinarily difficult. And then the technologies are different. I mean, the last 2 times I was in China, I had problems because you can't use cash. And I don't have a Chinese bank account, so I don't have WeChat money. So I mean, it's different over there. It's a very different environment. Should US companies get involved in a market of 1.4 billion people? Yes. I mean, and the fact that Google and Facebook were denied that access, that's been a problem for them. So I mean, I expect us to go, but whether we'll do very well, I think there are a lot of other markets where you'll do better throughout Asia.
Can I add a point to that real quick? I know we're, I totally agree with what Michael said. And if there's this big market, absolutely US institutions should be expected to go into it. I think what needs to be understood, though, is that when these institutions are over in China, fighting for market share, securities, and mutual funds, and asset management, and private wealth, good for them. But then they're going to have to be nicer to Beijing. Beijing will have leverage over these institutions. So when these same institutions come out and say, hey, we believe Chinese economic data, or we believe the Chinese policies on this or that, we should not believe them, because when they go in, they are beholden at that point to the whims of Beijing. And they are not allowed to say certain things. And part of those certain things they're not allowed to say are negative things about the economy. So we need to be very careful about getting economic messages from these guys, because they're compromised.
So we have a number of questions here about currency and cultural aspects of the China-US relationship. I'm going to start with the cultural one. An interesting question from a GIC member. Is it possible that we would see the international language of aviation globally change from English to Mandarin? Who wants to take that one?
Yeah, it's not just Mandarin. What Americans don't understand is Chinese characters. Chinese characters dominate Asia. You use the same Chinese characters in Korea and Japan and many other countries as you do in China. The words that are attached to those characters are completely different, but the symbol for plane or the symbol for wind is the same across Asia. And that has given the Chinese a huge leg up in how they interact with countries over there, because language, is an enormous barrier. I think the Chinese want standards going their way, but I don't think that they necessarily want them to be in Chinese characters.
Leland, anything?
No, sounded good to me.
Good. So then the currency, and Michael, you commented earlier that it's going to be very difficult for the yuan to become a global reserve currency of that stature for some time. Could you maybe just talk a little bit about your near-term currency outlook for the Chinese currency, and then Leland, after Michael, if you can just talk about your outlook as well, including not just the yuan as a potential reserve currency, but what happens with the dollar as a reserve currency?
Yeah, so I think maybe even more important than the yuan as a international trading currency is the US SWIFT system. The Chinese are terrified that they will be denied access to the US SWIFT system. This all started when Credit Agricole did a deal with Iran that the United States said violated the sanctions. And the deal had been a French bank paying money to an Iranian company and it touched the US banking system for a microsecond as it moved through currency transactions. And as a result of that, they fined Crédit Agricole $2 billion. So the Chinese saw this, and they've seen threats associated with what would happen if they were excluded. That's one of the reasons that Hong Kong still exists as Hong Kong, is because it would have to be the replacement for the SWIFT system if you did it. This is why the Chinese are interested in sovereign cryptocurrencies. It's also why they're forcing more and more of their trading partners, like the Russians, like the Saudis, et cetera, to deal in yuan for sales of things that are going back and forth between the countries. But it's still a long, long way before they're even the pound, never mind the euro or the yen. And it's decades before they're the dollar. But each march starts with a single step. So you're going to see more pressure to use yuan in transactions.
Leland, anything to?
Yeah, the framework I would use for the currency would be, let's look at this in a vacuum. In general, the Chinese want stability of the yuan versus the dollar. I would argue that the basket is mostly a rhetorical device to move against the dollar, but what they want is stability versus the dollar, with a slight bias of strengthening to increase purchasing power for Chinese households. If you're going to increase consumption in China, one of the easiest ways of doing something that's very, very difficult is to strengthen the currency so families with yuan in their pocket can buy more. So I think that the Chinese would love an international, pure international stability, stable dollar, to have the yuan stable against that dollar with a slight upward bias. And that's perfect. PBOC goes home happy and has nice sleep-filled nights. The problems you're looking at right now is you look at a potential much weakening Chinese economy over time that could hit the currency in one way. On the other hand, you've got a treasury printing zillions and zillions of US dollars right now, which could push things in the other direction. So it's unclear how this is going to play out over time. Certainly there's more geopolitical risk right now going into as we enter the next 2 months. But overall, the Chinese would like nothing more than stability with an upward bias. And if they can keep it that way going forward, then they'll be happy.
Great. Thank you both for that. So this will be our last question, and it'll go to both of you. Looking 12 months out, what's the one thing you're most concerned about, and what's the one thing you see as the biggest opportunity with regard to the US-China relationship? So Michael, I'm going to pick on you first, if I may.
I guess I don't really think about any one thing. There's as Leland pointed out, there are 4 buckets, and within each bucket, there's 10 other things going on. That's like asking, what's the one thing that you and your wife are going to argue about over the next year? I don't know if it's that chair over there, or if it's the backyard, or if it's the what. I think that's the key, is it's just got to be a flexible relationship. And I think far too many people put this in the Cold War, Russian, US. We did no trade with the Russians, and the Russians had a complete, separate system. This is not that. It's not the Japanese situation of the 1970s and 80s, but it's a lot closer to that than it is the Cold War. And so it's very nuanced. You have lots of different things that you have to trade off. And that's the point. You have to trade them off. You may have to take something that you don't like in Hong Kong to get something you want on phase 1. You might have to take something you don't like in Xinjiang to get something that you want on access to markets. You're going to have to trade off.
I'm gonna be a little bit more specific. I'm gonna go back to something I said earlier in my talk. I think that September 10, 2021, when we're redoing this talk, I think what we're going to be focused overwhelmingly on it is what's happening in Xinjiang. I think it does have legs, and I think that what we're going to be talking about is amidst a sea of grievances, we're going to be talking about whether Beijing is going to either lose the Olympics or have the Olympics boycotted because of what's happening with the Uyghurs in Xinjiang. I think this issue does have legs, and I think it's going to pick up dramatically in 2021.
Great. Well, gentlemen, we're going to have to leave it there. So Michael Drury, Leland Miller, thank you for being here. Thanks for sharing some very thoughtful insights with our GIC community. I hope to see you both in person soon, someday. But until then, please be safe and thank you again. So audience, the executive briefing will be back next week on Tuesday, not Thursday, but Tuesday, September 15th at 4 p.m. to discuss climate change. The 2020 Atlantic hurricane season has produced 5 hurricanes. We've had 17 named storms. There's been roughly 5 million acres burned throughout the United States from 41,000 wildfires. So please join the GIC chair, Kathleen Stephenson, who will host a very interesting conversation with renowned scientist Bob Bunting, who's the founder of the Climate Adaptation Center. Again, that is Tuesday, September 15th at 4 p.m. As a reminder, today's webcast and replays of all the past episodes of the executive briefing are available on the GIC website. To find the replays, explore GIC membership, or to donate in support of the GIC programming, please go to our website at www.interdependence.org. And as we conclude, we encourage you to take 60 seconds to respond to our audience survey. Your feedback is very important to us. Let us know how we can improve the programming. Thank you very much for your attention and good afternoon.